What if the government created a new $12,000 tax deduction just for seniors, but it vanished completely after 2028? It's not hypothetical, it's real. And many retirees are on track to unintentionally miss out. They may assume they qualify when they don't, overlooked income limits, or simply missed the deadline because they didn't understand the rules. This isn't clickbait or a rumor. It's a meaningful change to the US tax code already signed into law that creates a limited 4-year window for retirees. But there's a catch. The deduction has very specific eligibility requirements, and if you don't plan correctly, you may not benefit. In this video, I'm going to walk through 3 essential strategies that can help you position yourself to qualify for every dollar of this deduction. Hi, my name is Ben Lockery, and I'm a certified financial planner. I spend my days helping retirees make sense of complex financial changes just like this. Over the past few weeks, I've been digging into the details of a new law called the One Big Beautiful Bill Act. One major outcome of this legislation is the creation of a new tax deduction for retirees, the senior bonus deduction. It's one of the most substantial planning opportunities I've seen in years, but it comes with rules that demand attention. There are income cliffs, phase-outs, and deadlines that could result in many eligible retirees missing out entirely. And often, they won't realize it until it's too late. Today, we're going to walk through the full playbook, what this deduction is, how it works, and 3 critical strategies that can help you optimize for it. Let's start with the basics. This new deduction is not automatic. The government isn't sending checks. You must qualify and actively claim it on your tax return. Here's the overview. Beginning in 2025 and ending after the 2028 tax year, the new senior bonus deduction allows those age 65 or older to claim an additional $6,000 deduction on top of their standard deduction. For married couples filing jointly, that amount doubles to $12,000. But both spouses must be 65 or older to qualify for the full amount. If only one spouse meets the age requirement, the deduction is $6,000. The biggest potential pitfall? The income limits. To qualify for the full deduction, single filers must have a modified adjusted gross income of $75,000 or less. Married couples filing jointly must have a modified adjusted gross income of $150,000 or less. Above those limits, the deduction begins to phase out at a modified adjusted gross income of $175,000 single or $250,000 joint. It disappears entirely, and it's a hard cutoff. You go $1 over, and the deduction could be gone. Let's look at an example. Meet Carol and Tom, both retired and age 68. In 2025, they plan to withdraw $100,000 from their traditional IRAs and receive $42,000 in combined Social Security benefits. Because of their income, up to 85% of their Social Security is taxable, about $35,700 in their case. That brings their AGI to approximately $135,700. Since that's below the $150,000 threshold, they qualify for the full $12,000 deduction. Here's the impact. On top of the standard deduction, projected to be about $31,500 in 2025 for joint filers and their over 65 age boost, this new $12,000 deduction further reduces their taxable income. That could amount to thousands in tax savings if they stay under the income threshold, which brings us to strategy number 2, proactive income planning. This is a 4-year opportunity. The deduction is only available in 2025, 2026, 27, and 28. And it requires that you manage your income each year to stay under the eligibility thresholds. Take Carol and Tom again. This year, they're under the limit. But what if next year they need to replace a car and withdraw an extra $20,000? Their income jumps to $155,700, and now they risk phasing out the deduction. That's why it's critical to map out your projected income and big expenses across the next 4 years. Ask, how much do we need to withdraw from IRAs or 401ks annually? Are there one-time expenses coming up, such as home repairs, travel, education gifts? When do our required minimum distributions even begin? Answering these can help you smooth income across multiple years, avoid income cliffs, and make more tax-efficient decisions. And now, strategy number 3. Leverage this opportunity to consider Roth conversions. A Roth conversion means moving money from a pre-tax account, like a traditional IRA, to a Roth IRA. You pay taxes on the converted amount now, but then that money grows and can be withdrawn tax-free in the future. Here's the opportunity. Because this new deduction lowers your taxable income, it may open up space to do Roth conversions at a lower marginal tax rate. Think of it as a tax discount window. Back to Carol and Tom. Their AGI is $135,700, and with deductions, their taxable income drops to about $89,000, potentially placing them in a lower bracket. That gives them an option to convert an additional $10,000 or $20,000 to the Roth while still staying in a favorable tax range. This move has long-term benefits. It lowers future RMDs, reduces taxable income in later years, and increases tax-free income sources in retirement. To help make this more tangible, I've created a free 2-page guide that summarizes the key numbers, dates, and planning questions. You'll find the link in the description. Let's recap. Know the rules. The new deduction offers up to $12,000 for qualifying seniors, but comes with strict income limits. Plan ahead. Use a 4-year income plan to maintain eligibility through 2028. Strategize. Consider Roth conversions to maximize tax efficiency during this window. The opportunity is here, and with the right strategy, you may be able to take full advantage.